This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 164. Are we on the verge of a global recession?
Well, as we're recording this on the 27th of August 2019, the yield on two-year government bonds in the United States is 1.55%, and the yield or the interest you'll earn on a 10-year bond or treasury is 1.51%. That's an inverted yield curve. The 10-year rate is below the 2-year rate and well below the Fed's policy rate of 2%. So does that mean a recession is on the way? We'll look at that today on the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. So it is the normal case that an inverted yield curve leads eventually to a recession. It's all to do with the interest rates paid for bonds. So you buy a bond, you get a certain percentage back each year, and it fluctuates as bonds are traded for different prices on the secondary market after they've been issued. So if you buy the bond cheap, you'll get a better interest rate or yield. So when bonds are in demand, prices go up, the yields go down. And bonds are issued in varying lengths by the Treasury in the United States. They've got 1 year, 2 years, actually 6 months, 5 years, 10 years, even 30 years. And the longer the duration, the better the return you'd expect because you're taking a bigger risk because who knows what's going to happen in 30 years. So when short-term bond yields are higher, that means people expect something is going to be happening in the short term. They don't want to go and buy shares. They want to buy bonds because they're safe. So they push the price up. The yield goes down. The yield curve inverts. That is the theory. And every time the yield curve has inverted, a recession in the US has followed. Every time since the 1980s. 4 yield curve inversions, 4 recessions, and it's happening again, and it's sticking around for a little while. It certainly doesn't inspire confidence, does it? That speculators are so worried about where to put their money that they're going to put them in bonds where they're going to earn so little. And in some places, you actually have to pay to own them. Bond yields are seriously into negative territory in places like France and Germany. So, Steve, does this all signal recession to you, or is it just that shares have got so high, people are worried that they're going to crash, and that doesn't necessarily mean a recession is going to follow? Or what do you reckon? Is in other words, is 2020 going to be 2008 all over again?
No, definitely not 2008 all over again. That's one thing I've been be emphatic about, because the basic cause of 2008, as you and I've discussed countless times, and central bankers have never discussed, was a collapse in credit-based demand that went, in America's case, from plus 15% of GDP in 2007 to minus 5% in 2010. And that was after America got to the highest level of private debt it's ever had in its capitalist history.
Right. So we don't have that problem now, apart from places. We don't have that now, apart from obviously places like Australia. Well, yeah,
we have a number of countries that are in the same. Like if you imagine what was happening back in 2008, one way I can make an analogy about it was somebody running up a hill towards a cliff. And you couldn't say when the cliff was going to hit in, because that depends upon different countries' economies. But in the case of Japan, for example, that cliff was hit at a level of about 200% of GDP of private debt. It finally peaked at 225. There's a difference between running up the hill and if you continue rising even as you approach the cliff. Falling off the cliff is where credit demand goes from positive to negative. And in America's case, that happened when private debt was about 160% of GDP. It then peaked at 170. Now, since then, it's fallen. The level of private debt's fallen to about 150%. It's reviving very slowly now as a percentage of GDP. But in a sense, once you've got pretty much the same level of debt, but about half the level of credit, in the sense that the rate of change of debt now, which I define as credit's about 7% of GDP. Back when the crisis hit, it was 15% of GDP. So going from plus 7 to minus, to say minus 5 is bad, but nothing like going from plus 15 to minus 5. And I don't think they're going to go to minus 5 anyway. So you don't have the same decline in credit-based demand that you had back in 2000.
So what's going to cause it this time, then? Because everyone is in a very different position, aren't they? I mean, there's if you look at look at the United States, for example, they're carrying a lot of government debt. But you indicate many times that that's not really that important in the scheme of things. If you look at Germany, they've got no debt. They're trying to balance their books, and they're actually in bigger trouble than the United States is. Look, if we look in the UK, I mean, the Bank of England, are saying if it wasn't for Brexit, they'd actually be pushing rates up now. So if we are heading to a recession, and there's a whole myriad of different reasons, perhaps, as to why it's going to happen, but also different perceptions of whether it's going to hit their country or not.
Yeah, I mean, to me, there are three basic situations the global economy finds itself in. One is what I call, in Can We Avoid Another Financial Crisis, I call the walking dead of debt. And those are countries like America, Japan, the UK, Spain, which had already had debt crises back in 2007, and private debt was now falling. And those countries, they're carrying such a level of private debt that you can't encourage people to take out debt faster than GDP is growing. And in most of those countries, debt is slowly falling. But it means credit-based demand is quite anemic. And if central banks like the Fed did do in the last 2 years, federal banks who don't even take a look at the level of private debt, they completely ignore this particular indicator. Don't take a look at it. Their model tells them that with low unemployment, there's going to soon be high inflation. So they've got to put up interest rates to stop the high inflation happening. They put the rates up. Nothing actually happens. Inflation continues falling, which boggles their minds, but that's what's been happening. So what they actually do by putting up the rates is put pressure on people who are currently in debt, which means they're more likely to reduce their debt or go bankrupt. And it makes people who aren't in debt less likely to take out debt. So consequently, credit demand goes negative, and you fall back into another credit-induced slump, but it's a small one. It's like the ones that Japan was going through after its bubble economy burst back in 1990. It never had a crash like 1990 again,
right?
But it had stagnation for the whole period. So that's part of the economy. Well, I see being in stagnation.
So that's one. Yeah.
Okay. That's the majority, not the majority, but a large part of the global economy, because you have, that's the United States, it's the UK, it's most of Europe, certainly Spain, Portugal,
Southern European countries,
not France, but substantial countries. And then there's countries which avoided the crisis back in 2008 by continuing to borrow. So Australia's the champion there, but so is Canada's in that list, so is South Korea. A range of other countries, even including places like Norway and Sweden, are in that situation. So they can have a debt collapse. They can have a private credit crunch. And I think Australia and Canada are certainly having that. So they're going to have it. And when you add them up, there's something like about 20% of the global economy that you could put in that bracket. That's substantial. But that also includes China. And that's another wild card, because China has such a level of government spending and no qualms about, balancing the books and all that sort of nonsense. So they've got the Silk Road project, they've got the infrastructure projects. That is counteracting the impact of the credit. The third class, that's like the three classes, so I better mention a fourth. The fourth is countries like Europe, which are imposing policies which they believe are prudent, but are actually stagnationist. We should have a good talk about this in a later podcast, because Germany's focus on not running a deficit at the government level and preferably running a surplus is one point that the modern monetary theory is quite correct on. And that is that if you do that, the size of the government sector surplus is identical to the rest of the economy deficit. Now, if you're running a trade surplus, you can still balance that, because the trade surplus causes domestic money to be created to make up for the money that's being destroyed by the government or taken out of circulation by the government running a surplus. But with Germany's trades, by what I can tell, its trade surplus is rather anemic compared to past trends. The overall effect of everybody in the economy trying to save money, so households trying not to take out debt, and because Germany's household debt levels are quite low and not rising, the government trying to pay down debt, the trade surplus not making up sufficiently for those two actions, the economy is going to decline.
Well, I mean, it is, isn't it? Already.
Yeah.
I mean, there's every chance that it is already in recession in Germany. The German government has actually said, though, the reports are suggesting that they are going to start pumping money into the economy if they get into a recession, which by which time it might be too late by then. Why not do it now? But I mean, on the first one about the role of central banks, I mean, interest rates have been low everywhere for a long time. Okay, the Fed lifted rates, but they're taking them down again, and they're going to take them down further than they lifted them. I mean, the move, apart from the Bank of England saying if it wasn't for Brexit, they'd be pushing rates up. The move generally is down from central banks and has been for a while.
Yeah, and we're in what we are in is in a deflationary environment, and this is I'm quite pleased that I called my website debtdeflation.com about what was that, about 20 years ago, and
because here we are.
The one time I've actually ever speculated is when my first wife wanted to buy a property, and I made the mistake of saying we're in a bubble and I refused to write a bubble. That was 1997. God knows how much we would have made on a property speculation back then in Sydney. But I bought bonds in the belief that interest rates would fall.
Yeah.
And like I had a debate with an Austrian economist at the time, who of course all are basically seeing inflation coming out of government spending. And I was saying, look, I'm sorry, the tendency I see is deflation. And he said, well, if you put any money on it? And I said, yes, I bought $200,000 of government bonds, unlevered, of course, typical me. And by the time I sold them, they gained about $30,000 in value. They would be up about 60, 70 now if I'd held them for longer. So this is something which comes out of Minsky's financial instability hypothesis, not as Minsky wrote it, because he actually was writing predominantly during the 50s, 60s, 70s and 80s, and he saw the huge inflation that occurred pre-Volcker coming into power, and he basically extrapolated that forward, thinking inflation would be the result of government spending making up for private sector declines. But of course, two major things happened that upset that apple cart. One was, of course, China coming onto the market, which is itself a massive deflationary shock to the capitalist economy, because suddenly a non-capitalist economy with incredibly low living standards becomes a producer on the global market, and it cuts all industrial countries' prices. That helps. But when I put the maths together of Minsky's hypothesis in a complex systems model and included prices, before I included prices in it, one of the tendencies that came out of the rising level of private debt was a falling wages share of GDP. And it's absolutely lockstep. So as the debt level goes up, private debt, the worker share goes down, even though in my model it was firms doing the borrowing and not the workers. So what we could get a bit hairy explaining that one. Maybe that's one for another day as well. But that wages share maps directly across to the rate of inflation. And when I built a model including prices, I got deflation coming out of that, and the inflation rate getting down to -1%, -2%. Now, in that situation, if you've got negative inflation of -1 and -2, then, and if you're in the aggregate, if you actually have declining GDP as well, but if negative inflation like that is a good reason to hang on to bonds that give a slightly higher yield, even if it might be low or negative. So
but we're not quite there yet, though, are we?
Not quite there yet.
We don't have rampant inflation. We still have some inflation, but I mean, admittedly, it's the lowest it's been for a long, long time.
Yeah.
People are still buying. There's still consumer confidence. Retail sales are holding up in the US, in the UK, and many other places as well. It doesn't feel like we're on the verge of a recession if you look at.
No, and I don't think it's a recession. It's not a crisis on the scale of 2008, because there will be some cutback in credit-based demand. There will be workers. Wage rises haven't come through, so people are carrying, in the real world, people are carrying household debt, credit card debt, and things of that nature. It makes them less likely to spend the money they currently have, so the velocity of circulation plunges. And that's where you look at the empirical data. One of my favorite charts, which people can find by going to the St. Louis Fred site, which is a marvelous website. Go to the St. Louis Fred. It's actually for Federal Reserve Economic Data, so they call it FRED, probably one of the best acronyms going. And there's a thing called money of zero maturity, MZM. And I look for the velocity of MZM, and you'll take a look at quite a striking chart, one that I really want to get into analyze properly one of these days when I have time. And you'll see that the velocity of circulation of money of zero maturity is now 1.33, meaning if you have $1 billion, it turns over 1.33 times a year, so it creates $1.3 billion worth of demand. If you go back to the pre-inflation periods in the 1960s, 1965, it turned at about 1.8 times. So $1 billion worth of money created $1.8 billion worth of GDP. And if you go to the high inflation period before Volcker hit the brakes back in 1981, it turned over 3.5 times. So $1 trillion created $3.5 trillion worth of GDP. Now we've been on a downward trend ever since.
And we've argued many times, you've argued many times, that is because so much more money now is finding itself in the finance sector, and so it ticks over slower there than it does if it's in a sort of general trading environment, buying and selling stuff.
And at the same time, people are carrying so much debt that they are cautious about spending.
Yeah.
But where the individual caution about spending translates into a fall in GDP. And this is one of the most important points that I've derived in the work in the last few years on the role of credit in aggregate demand. And this is one where I'm completely consistent with Richard Werner, who derived the argument earlier than I did with a different form of logic. And that is that credit adds to aggregate demand and aggregate income. When you live in a world in which banks create money, which of course that's the world we do live in, not the one that neoclassicals inhabit in their textbooks, but the real world, credit adds to spending power if you have the bank gives you a loan, its assets rise by as much as the new loan. The new loan, you don't take out the loan for the sheer pleasure of being in debt. You spend the money you've borrowed. You're buying a house. You're buying a video. You're buying I'd better say a tape recorder. That's going to age me, isn't it?
I think so. I've heard. Go to the Science Museum, kids. Let's just go on there.
That's true. You're buying a 100-inch diagonal TV. You swipe your credit card. That creates additional debt on your liability side. On the asset side of the company you bought it off, it creates money. And then for the banking sector, it's creating an asset, which is the debt you now owe to the banking sector. So that expenditure is expenditure for you. It is income for the company you bought the 100-inch screen off. And that process can go into reverse as well. When you pay money off, you're reducing the amount of money in circulation by precisely as much as you reduce your debt. Money which could have been spent is now used to cancel outstanding debt. So credit's part of aggregate demand. And if you have this world in which people aren't willing to take out the credit, then part of aggregate demand is lower.
So is how much of, because you mentioned China briefly, but you haven't, in your list of 3 reasons, you didn't give the one that many analysts are blaming on all of this, which is Donald Trump's trade war, because, that's stymied investment, not just in China and the US, but in Europe too. And we've got industrial production has fallen in all those places. So manufacturing has been hit hard. And it has to be in part because of this trade war, because either that or it's just a massive coincidence, because the worse that trade war has got, the more cautious industry has become, quite naturally.
Yeah, the other side of it, and this is the question of how far it's going, are American corporations getting sick and tired of having the supply chains disrupted, and are they investing domestically to replace overseas production? Or are they, in cases of Vietnam benefiting right now, are they moving out of China? So there are some countervailing factors there, but yeah, you've got a bull not just in the China shop, but in the entire suburb, and that's the danger that is adding to it. That is certainly contributing, but to me that's I would call it second order compared to what's happening with credit demand. Right,
because the significance of China, and what's happening, because a quarter of US imports come from China. So, and if that reduces, as it is with this tariff battle going on, then, the idea is that it somehow is instantaneously going to be replaced by goods made at home. But surely it means that's not going to happen, obviously. Surely it just means consumption is going to go down, and that's going to lead to a downturn.
Yeah, so I think Trump is definitely contributing to it, but I think that the overall background is debt trap we've got ourselves in that central banks aren't even aware of when they put rates up.
Yeah,
so this gives us this deflationary environment.
So what's the answer then? What do we do? Central banks can't lower interest rates, really, can they? Well, they can, but does it really make too much difference? Because if we look at just before the 2008 crash, interest rates were in the United States were at 5.25%. So there's a huge amount of room for movement. Now they're at 2.25%. They're probably going to get down to 1.5% by the end of the year, early next year. So there's not a lot of room for movement. And then, of course, if you look in the UK, it's down to 0.75% already, and it's in negative territory in France and Germany and other parts of the world. So what can central banks do to try and adapt to all of this? And is moving interest rates the right thing anyway?
No, this is the thing. What you need is in the conventional sense, what you need is massive fiscal stimulus, which Germany is finally contemplating after years of believing that it would be. This is one thing people tend to forget. You do not impose an economic policy because you think pain is good for you in the future. You impose it because you think you're going to have a better situation in the future. So Germany choosing to target a balanced budget of the government and preferably surpluses was supposed to have the impact that Germany would be growing more rapidly than the rest of the world. In fact, it's having the impact of going into a recession. Now, the ideology will change. They'll talk about how it's, we have to be responsible. And yes, responsibility has costs. No, responsibility was supposed to lead to achievements, but they'll reverse the rhetoric, I'm sure.
So what about China then? Because are they going to, because the first global, the global financial crisis, 2008, had very little impact on China because
it actually had a large impact, but it countered it very rapidly. People tend to forget this because it was so dramatic and so fast. Because when the crisis hit, I remember, I can't actually quote chapter and verse on this, but I remember reading that when the crisis hit in 2008, over about a year, China's exports fell by about 40%.
Yeah.
I think it was 46% is the figure that sticks in my mind. Now, what that meant was there was a massive migration of workers from the coastal cities back to the countryside, because in China, you have to be registered somewhere to which you get what passes for social security. You're registered in your commune or your communal area, which were a huge number of the workers in the coastal cities during the boom was back in the provinces. And of course, the provinces are doing fine because they're getting government subsidies to make up for that. They haven't got the industrial sectors that the coastal cities have. Suddenly, you have 40, 50 million people coming back because they're being sacked on the coastal cities. They can't stay there because they'll get zero income. They've got to hop on the trains and go back into the countryside again. That huge exodus of very angry people was why China went rapidly for the huge credit stimulus that began back in 2009, 2010, when it basically told us banks to lend to anybody with a pulse, and we got the phenomenon of ghost cities being built all through China.
Right, but they're still doing that, of course, aren't they? I mean, their whole approach is to try and offset the impact of the trade war by making loans more available to try and boost investment in business. I wonder if that's going to be enough. And if it's not, and we are starting to see signs of a downturn, and when we used to say, look, when the US economy sneezes, the rest of the world catches a cold. I think that's changed now, isn't it? It's when China sneezes, the rest of the world catches a cold.
So could this... Chinese data right now from the Bank of International Settlements, and as much as you can trust the data, the level of credit-based demand in China peaked at 40% of GDP, 40. That is the data I'm reading right now. 40% of GDP. That was back in about, and my graphs are a bit inaccurate. This is a new software package I'm working on, so I can't actually give you the precise data, but that's about 2010. Down, back up again, heading down again. Now it's about 20% of GDP. Now, that's still an enormous amount of demand, but 20% is a hell of a lot less than 40%. We are getting a credit-based slowdown in China. The question is, to what extent is that counteracted by the government spending? The obvious answer is more than Germany, but whether it's enough to mean that China's overall contribution to demand for goods from the rest of the world is positive or negative in terms of the change, I'm not really sure.
Well, then there's the interesting thing as well, isn't there? Because China is demanding more from the rest of the world. I mean, it used to be very much an export-based economy, and now its domestic consumption is rising. And so the net trade surplus, which was 8% of GDP in 2008, is now just 1.3%. So, in short,
a huge change.
A massive change. I mean, now they make their own stuff, they consume their own stuff. I mean, do they need us, and do they actually have that same influence in the rest of the world? I mean, are they sort of building almost like more of a closed ecosystem because they're looking after themselves so much?
Well, I mean, they're not so much a closed ecosystem. They're actually less closed by the fact that their trade surplus has fallen. in that sense. I mean, when you have a trade surplus like that, you insulate yourself from what's happening in the rest of the world. When your trade surplus falls, which has happened to Germany and apparently well as Japan, then you're more exposed to what's happening in the rest of the planet. So they're having less power, but I'd say more influence.
So how do we avoid this happening, or is it just going to happen? And who's going to feel it the worst?
Let's come back to what we're talking about, which is that there are going to be a global recession. I can see a slowdown in America. Maybe, I mean, I did say back when I wrote Can We Avoid Another Financial Crisis, I expected a recession in America in 2020 during the election campaign. Because I thought that the central banks would do precisely what they've done, put up interest rates to try to spike off inflation, which didn't happen, cause a credit-based slowdown instead, and then have to go into reverse to counter it. So all that has actually happened. As I expected.
Right. But Donald Trump has protected himself against that during the next election by saying, hey, look, he can say, well, I've been telling them we should have had a 1% drop in interest rates. They should have gone a lot further. They were too slow. So he can blame the Fed if there's a slowdown.
And I also, I hate to say it, in the book, I also predicted that Trump would make his next election campaign against the Fed rather than against his Democratic rivals, which is what he's doing. But I'm sort of 50-50 on whether I think America will actually have a recession now, because the scale of spending that he's triggered, even though the tax cuts have gone to the wrong people as well, all that sort of stuff counteracts the private sector downturn. But certainly it's nothing like 2008. But in terms of some countries around the world, yes, there will be recessions. Countries like Australia, Canada, potentially the other countries that have got a huge debt bubble, including France. I'd put France in there as well as Sweden, Norway. These are countries I remember after looking at data in front of me right now. So there's a number of countries I would expect to have a recession. Adding up to the global scale, a global recession, I think a bit like the old saying about the parson's egg. It's good in parts. There'll be some parts of the world that don't have a recession, but plenty are going to have one for one of those three factors. Either their central banks, the governments aren't stimulating the economies enough because they're relying upon the central bank that don't have the ammunition anymore, if they ever really did, in terms of interest rates affecting economic activity. You have the country that are going to have a recession because they boomed their way through the last crisis by borrowing more private sector debt, or you're going to have the countries which are in stagnation and can be easily triggered into a downturn, which could be America.
So you haven't mentioned Europe, and yet, Germany is the closest to it.
Europe is self-inflicted. And this is the danger that, like Germany, the ironic thing is Germany is the overall beneficiary of the design of the euro, and yet it's having a recession. And that just shows how crazy its focus upon balancing the government books is.
Yeah, but they can be in recession, but everyone's still a lot better off than people living in the south of Europe, of course. I mean,
that's terrible. I mean, that's disastrous. I mean, I know programmers are now have been charging themselves out like this is guys with PhDs in the southern European countries at rates like 10 to 15 euro an hour. Those are the sort of rates you used to expect to get when you hired Indian programmers. So
this is it, isn't it? We can get a bit too hung up on the recession word and say it's awful that countries are going into recession. The other ones might be not be going into recession, but they're growing so slowly and wages are so suppressed. Like the UK might avoid a recession, but you still got a record number of people going to food banks to get fed. So it's not exactly a sign of a healthy economy, is it?
No, and this is we've seen certainly seen a slowdown in the overall global rate of growth over time as well. If you go back to 1950s America, then you saw an average growth rate in real terms of the order of between 3 and 5%. And if you do the trend over time, it goes from about 5% down to about 2%, 1% now. Now, I would attribute a lot of this to the impact of rising private debt on the other side, but equally there are things like, in terms of energy, we know the cost of energy is getting to be higher. With the higher cost of getting energy out, you can't produce as much, I won't call it a surplus, but you can't convert as much of that energy into goods as you could beforehand. Your capacity to generate a growing real standard of living is declining for a whole range of reasons, all coming together at once. And in the middle of all that, people are looking at long-term yields and thinking, where is safety in long-term yields? They're willing to buy the government bonds to get that. And you're locking in a long-term, not a gain, but a long-term minimization of potential loss, and bang, you start getting negative rates and the inverted yield curve.
Right, but what you've just described there doesn't sound like a temporary problem. I mean, you think of a recession, you go into a recession, you get out of a recession, you go in cycles. But what you're describing is stagnation. I mean, and you're saying the root cause of all of that is the fact that we're just not energy just isn't as cheap, and it's not as plentiful to try and give us the growth that we've been used to in the past. So get used to it. This is the new normal.
There's two elements. One is the credit one is the one that overall I'm saying I have to make a strong argument on credit because I've got the data in front of me and so on. So yes, we're not going to ever get a credit stimulus before like we got between the 1950s and the 1970s, and occasionally got after that as before the bursting of the bubble in 2008. We're not going to get that again because we're carrying such a level of private debt around the world that credit growth, which is the credit which I define as the rate of growth of private debt, will never be substantial once more.
Unless we have a moratorium on debt, unless we just write it all off. And
you have to write it off. In my case, has always been the only way out of this is an accounting exercise in writing off the debt, which we have the capability of doing, a modern debt jubilee. But the other side of it, of course, the ecological one coming as well, then yes, that's going to have more of an impact. You're not simply getting the same physical productivity out of your economy either. And of course, to me, the real danger is that's the good news. The bad news is when we realize just how much we've stuffed up this planet. Yeah. And either we have to go into reverse or the system goes in reverse on us. So
it seems like whatever central banks do now, then it's going to be ineffective. So we've got, I mean, because they can't move interest rates lower, as we've said, because they're already, in negative territory in lots of places. So the ECB, for example, we've been hearing that, rumors that next month we can expect a bazooka of stimulus from the ECB, including they can't cut interest rates too much, but more, going back to quantitative easing, perhaps in a big way. It's probably not going to make too much difference then.
Well, quantitative easing is part of the problem, and because it is a very, very expensive way of getting a stimulus. Not that the government has an unlimited capacity to create money. So, but if you want to have create money and have an impact, then what you do is you give money to the poor, because they're going to spend everything. Okay, it's going to end up in the shop straight away. If you give it to people, if you give a universal basic income or a tax rebate, which was Australia's trick back in the 2008 crisis. If it goes to the average person, or even better, goes to the poor, then bang, it'll get spent. It turns up as expenditure straight away. Yeah. And
unfortunately for Australia, let's just look at that. I mean, because there was the argument, wasn't there? A lot of it went to Harvey Norman, the retail store, because there was a lot of demand for flat screen TVs at the time.
Which went to China.
So it went to China, exactly.
It goes overseas. That's one of the dangers of open economies, and also not having a manufacturing sector, which is Australia's special talent. But yeah, there is no way that the central banks themselves can stimulate it. But at the same time, you have a mindset, and this is where the danger of economics, mainstream economics, becomes so obvious. Mainstream economists really believe that they can control the economy using the interest rate. This is the whole idea of DSGE models. And the fundamental thing about these particular models versus the type of models economists did before they got taken over by the rational expectation mob is that they've actually included the central bank as part of the model. And the central bank follows what they used to call a Taylor rule. And that is that whenever there saw a 2% rate of inflation as being the norm, and wage demands driving inflation rate up. So the story was you should move interest rates roughly twice as fast as wages were changing to keep you around this 2% rate of inflation. And then with the 2% rate of inflation went a 3% rate of economic growth and a 4% rate of interest. 2, 3, 4.
Yeah.
Now, none of this is working for them. So that's why they've gone to QE, which massively stimulates the rich and drives up asset prices. It doesn't put it puts some money, but a lot of money into the domestic economy. Negative interest rates they're playing with as well, but the negative rates they can only impose those on the deposit accounts of banks at the central bank with the reserve accounts. Nonetheless, we apparently have negative interest rates on mortgages in Denmark, which really, really does twist my mind. But those are the only tools they've got, and otherwise they're floundering. Now, we could say there's a little lever over there called the private debt level. Pull it down, do something to reduce the private debt level. Huh? Why should we touch that lever? Yeah. According to our theory, it doesn't affect the economy. Oh, for God's bloody sake.
But it does affect the way that the bank, not central banks, but retail banks issue out loans, doesn't it?
Absolutely.
Because I look at it, I'm just in the process of taking out a loan to buy a house. There's only one company, one bank that would give me a loan in the UK, because they're also fearful, because they look at it, here's a man in his 50s who's working for himself. Okay, he can provide bank statements for the last 10 years to show that he's earned an okay living doing what he's doing, but I'm too big a risk.
And this conservatism about debt is because there's too much debt.
Yeah.
And the only way to get over it is to write the debt off. We have the capability. The state can create money, as it's done for QE. It could create it from modern debt jubilee, where the money was given to the public in a per capita way. With those in debt getters, it's a debt offset account. Those that don't have debt get money they can spend, or money they have to use to buy corporate shares that have been issued specifically to reduce corporate debt. This could be done.
Yeah.
But they won't consider it, because in the very first instance, their theory tells them the level of private debt and the level of credit don't matter.
And yet they look at China, where China is, their big stimulus at the moment is obviously to try and make it easier for banks to lend. So bank lending accounted for half of the GDP in China in 2009. But the problem was that went into, as we've seen here and elsewhere, if you make it easier to borrow, people put it into housing and they put it into the stock market. When that's all that happened in China in 2009, they had this big, made a lot easier to borrow money from banks, and the stock market went up.
Yeah. Yeah. So we have basically, it isn't just we have an economic problem, we have a theoretical problem. And that is the people in charge of central banks and treasuries and the people advising the mainstream economists around the world live in a world, understand a world that doesn't exist, and are therefore ignoring crucial data in the world that we do live in, which is this role of private debt, and also, I have got to say, also the role of energy. And leaving those two major factors out, you've got people who haven't got a clue what they're doing, and you end up in the situation we are now of them floundering around, trying the only tools they have got, which is pushing reserve rates even lower, and quantitative easing. And the only one which actually has any major effect upon the real economy is quantitative easing. It's a very expensive way of doing it. It makes the wealthy even wealthier, which is not exactly a solution to the problems we had back in 2008. But that's where they head. And then we just live in stagnation and political conflict as a result.
Forever. Amen. That's the world we live in. So, okay. So
I don't see a recession, but I don't exactly see happy times ahead either.
Right. More of the same, in other words. Yeah. All right. Very good, Steve. We always get back to debt, don't we? Wherever we start.
I wish we didn't have to, but I'm the only person talking about it apart from Richard Werner.
All right. Well, look, next time, let's see how you can bring debt into our discussion about how Britain can be more entrepreneurial. Maybe we can do that without using the debt word too much. We'll do that next week. Good to talk, Steve.
Okay, bye, mate.
Yeah, next time we are going to be looking at how we can, in a post-Brexit world, make Britain more entrepreneurial. Given that we have to make the best of a bad job. Well, it depends on what your attitude is. I think it's going to be a disaster, personally. Steve isn't convinced, but look, it is an opportunity for us to remove the shackles placed on us by Europe. And so, how is Britain going to lift itself out of the quagmire it is apparently in at the moment? We'll find out next week. We'll no doubt come to blows on that one. That's next week on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. I'll see you then. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.